Welcome to the Explainer. Beyond all the noise of breaking news and endless expert opinions, the stock market actually has its own secret rhythm. Today, we're going to listen in on that pulse. We're going to decode the hidden patterns that shape every single trading day, from that chaotic opening bell all the way to the final closing auction. So let's get right to it. Is timing everything? It's the million-dollar question, right? But while most people think timing is about predicting the next huge market swing, the real secret might actually be in understanding the predictable, daily schedule the market follows. Turns out, the answer is way more structured and, frankly, a lot more fascinating than you'd think.
Okay, so our journey starts at maybe the most famous moment of the trading day, that explosive, almost chaotic energy of the opening bell. And believe me, this isn't just for show. It's the beginning of a very specific and totally predictable phase of market activity.
That first hour, from 9:30 to 10:30 a.m. Eastern, is just pure adrenaline. It's all about high volatility and massive trading volume, because the market is trying to digest all the news that broke overnight. For really active traders, this is go time, perfect for quick moves and scalping strategies.
And this isn't just random chaos. Research, like this from the European Central Bank, confirms it. It's the market doing its job, processing information at lightning speed. And this powerful link between huge volume and wild price swings, you see it most clearly in the biggest, most popular stocks.
But after that morning rush, the market's whole heartbeat changes dramatically. The frenzy just dies down, and we ease into this much quieter, more deliberate phase, the midday lull.
So between roughly 11:30 a.m. and 2 p.m., both the volume and the volatility take a nosedive. People often call this the lunch hour. It's a time when a lot of the pros step back, which makes it a better time for just following existing trends instead of trying to force a bunch of quick trades. So, while the day traders are out grabbing a sandwich, does that mean nothing is happening? Oh, absolutely not. This quiet period is actually when the slower, much more powerful machinery of corporate finance often kicks into gear, working almost invisibly behind the scenes.
One of those powerful forces is the share buyback. This is simply when a company decides to buy its own stock right off the open market. Those shares that it buys back are then held by the company itself, and they're called treasury stock.
So why on earth would they do this? Well, there are some really smart strategic reasons. For one, taking shares off the market can boost the value of the ones that are left. It can make key numbers like earnings per share look better, making the company seem more profitable. Plus, it's a huge signal of confidence from the management team, basically telling the world, hey, we think our stock is a bargain. Okay, let's fast forward to the end of the day and see how we go from that midday quiet into this dramatic, high-stakes finale. Because the market doesn't just fizzle out, it goes out with a bang.
The final hour of trading, from 3 to 4 p.m., is famously known as the power hour. Activity just surges again. You've got big institutional investors, you've got day traders, all trying to close out their positions. This creates some pretty significant price swings and a lot of opportunities for momentum trading.
But all of this rising end-of-day activity, it's not just random. It's not just people heading for the exits. It's all funneling toward one single, highly structured and incredibly important event, the closing auction. Okay, let's pull back the curtain on what is, no joke, the single biggest liquidity event of the entire day, the New York Stock Exchange closing auction. This is the moment where the official closing price for thousands of stocks gets set in stone. And to get why this is such a big deal, just look at the scale of it. We're talking about roughly 7% of the entire day's trading volume on the NYSE getting squeezed into this one final moment. It's just a massive coordinated flood of buyers and sellers. So how did traders even get in on this? Well, they use special order types. A market on close, or MOC order, is basically you saying, I don't care what the final price is, just guarantee my trade gets done. A limit on close, or LOC order, is more like saying, I'll trade, but only if the final price is good for me. And this whole thing is timed like a Swiss watch, right down to the second. At 3:50 p.m., the exchange starts showing everyone where the imbalances are, too many buyers or too many sellers. Then after a few more deadlines, at exactly 4 p.m., regular trading just stops, and the auction instantly matches as many buyers and sellers as possible to create that one official closing price. So we've seen the whole cycle, right? The frantic open, the quiet middle, the super calculated close. But what does this daily rhythm really tell us about the market today? Why is it so important to get this pattern? Well, for one thing, these big, structured, centralized events are becoming more and more important. I mean, look at this. The closing auction's share of the total daily volume has basically doubled in just 5 years. In a world with dozens of different exchanges, this is where the real action is starting to congregate.
And academic research totally backs this up. This quote here really gets to the heart of it. These rhythms are all about how fast the market can absorb new information. Those big, high-volume stocks, the ones that are most active during these key windows, they get back to normal much, much faster after some kind of shock.
And really, this is the key takeaway. From the high-speed data crunching in the morning, to the slow-burn corporate strategy in the middle of the day, to that massive coordinated event at the close, every single phase of the day serves its own distinct and totally vital purpose in the market's ecosystem.
Which leaves us with a final, kind of provocative thought to chew on. In a world that is just flooded with 24/7 news and instant analysis, maybe the most valuable information isn't in the next headline. Maybe it's been hiding in plain sight all along, in the market's own daily, repeating, and powerful pulse.